when we look at China's leverage, I wouldn't describe their trillion. They have roughly $1 trillion in U.S. Treasuries, more or less. We can remember that back in March 2020, during the COVID crash, there was an issue where foreigners started selling treasuries, so the treasury market broke alongside the stock market, which was unusual because normally when the stock market's going down that much, people flee into the relative safe haven of treasuries. And at first, people were doing that until it got so bad that the foreign sector and risk parity funds had to kind of unwind in a disorderly way. And when that happened, the Fed came in and bought $1 trillion of treasuries in 3 weeks. They ended up doing multiple trillions of dollars in total QE. And so compared to China's, ability to sell up to $1 trillion in treasuries, I think that's something that could be absorbed. But I think that there are much bigger risks, between these two countries. One is that much like how Russia had their reserves, frozen, China is actually vulnerable to having their reserves frozen. So that's a risk on their side. A risk on our side is that China can, nationalize a lot of our companies' manufacturing facilities or otherwise cut us off. And that's a much bigger problem than just selling, half or all of their treasury stash in kind of a disorderly way. I think Luke Groban described it well, a fellow analyst. He pointed out that, Lehman was like a $600 billion balance sheet, whereas China, it's like a multiple tens of trillions of dollar balance sheet. So basically, the interlinkage between these two countries is so great that they have very significant ways to hurt each other, even more so than some of the ways that Russia and Europe, for example, have ways to hurt each other. Partially how high it goes, and it's also partially the speed with which it gets there, right? So if the dollar kind of grinds up slowly over time, it can get to a higher level without breaking things compared to if it just shoots straight up, which is what it did during that COVID crash. That's what triggered the foreign sector having to sell it. Because, if you look at foreign balance sheets, they have something like $13 trillion in dollar-denominated debt, according to the Bank for International Settlements. That's mostly not owed to the U.S. It's like owed to other foreign entities. So countries in Africa owe China, countries in South America and Turkey, they might owe European entities, right? It varies across the world, but it's denominated in dollars. And so if you have a situation where dollar-based cash flows are drying up while they still have all that debt, they have a problem. But one of the things that they can do is, the foreign sector has tens of trillions of dollars worth of U.S. assets. That includes stocks, treasuries, corporate bonds, and less liquid U.S. real estate. And so the entities that have those types of assets can sell those assets if they ever need dollars. And that's what we saw in that kind of March 2020 environment. And obviously some emerging markets are in better shape than others. So for example, Turkey's in a very rough spot because they have liabilities that exceed their assets in terms of international reserves. Whereas when you look at, a country like Brazil, they're in somewhat better shape, for example, and so they have more options available to defend their currency. We're also seeing, if you look at the dollar index, as strong as it has been lately, it's actually been more a factor of how weak the euro and the yen are. If you look at the dollar compared to a lot of other major currencies, it's been strengthening, but in many cases it's still below the highs it reached in 2020. Whereas, when you compare it to the euro or yen, that's a different story. It's kind of broken out against those. So I think that this particular dollar rally has not been as vicious on emerging markets as it could have been. But if it keeps grinding up, and especially if it goes up in a disorderly, quick way, that can absolutely put pressure on, especially the weaker emerging markets, the ones that have more debt than they have, international reserves. So Turkey's at risk, Chile's at risk. Argentina's at risk. Basically, there are a lot of these periphery countries, whereas I think other countries like China, Brazil, and places like that, they have somewhat more resiliency because they have significant reserves to offset their liabilities. Well, I think so. There's always a challenge in trying to determine tops and bottoms for anyone. I generally use kind of a dial in and dial out approach, meaning that if the market goes down significantly and sentiment turns very bearish and valuations improve, I generally put a little bit more chips on the table. I buy a little bit more equities. On the other hand, if we see, a huge rally and kind of a euphoric peak, I trim some of my equities and get a little bit more defensive. And it's not necessarily that I'm trying to time the top or bottom specifically, but it's rather that I'm just risk managing and kind of allocating around the margins. And so the first half of this decline was mainly valuations. So earnings were still holding up well, but as interest rates rose very quickly, we saw downward pressure on a lot of valuations for different equities.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
I have bad news for you. If you're not rich by now, you're screwed. And if you're in debt, you're even double screwed. How so, you might wonder? Well, the sad truth is that you're working your whole life to make someone else rich. The mega corporations, the banks, the politicians, everyone is getting richer. They get your money. And what is even worse, they get your time, they get your life. You are not even in a rat race, you're in a financial prison. But what could a solution for you look like? Honestly, I don't know, but I know what a solution for me would look like. It's very simple. I use whatever money I have and I multiply it with 1,000. This could make my life much easier and probably yours as well. If you have $1,000 available and multiply this with 1,000, I believe that this could solve some financial issue for the one or the other. Of course, if you're ugly, you would have to multiply it with much more than 1,000. My name is Markus Dahn, and this is what I decided to do. I decided to 1000x my money. This is not a joke. I know what you may be thinking. What is this guy talking about? How should this work? This is not possible. Well, I made a detailed video where I laid out my plan. And some clever folks might even want to look at this plan and copy it and do exactly what I do. This is just a little hint on the side. You have two options. You leave, you forget what you have seen. You do whatever you're doing and you hope that somehow you get some other results. Good luck with that. Or you click the link below the video. You enter your email address because I'm not showing this to everybody. You at least watch my video on how I plan to 1000x my money. The choice is yours. Make the right choice. Join me. See what a different future you could have. See at least how I intend, how I plan to do the 1000x. So click on the link below, enter your email address, and I see you on the other side. Your Markus Dahn.